Hi, and welcome back. Today we're going to take a look at market efficiency and best execution. We know that for our portfolio to do well, we have to make good choices. We have to find the best possible portfolio for our investors. But also we want to make sure that the actual trading activity is going to be efficient. One of the assumptions that we talk about in corporate finance classes, and finance professors love to talk about this, we talk about market efficiency. Most of the theory that we've generated is based on a foundation that essentially says that markets must be efficient for all of the things we talk about to work. We say that in an efficient market, stock prices can't be predicted. Essentially, the price that we have today, the price that is broadcast or is listed for a company, is essentially what the company's worth, because markets use informations effectively. The two pieces of information that are provided about any stock will be the central tendency or the expected value, and a probability distribution that gives us a high and a low range for trading. When we say that stocks are effectively valued by the market, that the market gives us good information, we say that anyone who tries to predict a stock will be wrong, either up or down, depending on random numbers, random information. And that's what we mean by a random walk. The efficient market hypothesis essentially says you can't beat the market through trading, and that perhaps the best thing to put your money into would be an index fund with complete exposure to all of the different stocks and the lowest possible trading costs. In fact, Burton Malkiel has produced one of the best-selling books ever, essentially telling people that this is how the efficient market hypothesis works. The text, A Random Walk Down Wall Street. So we say efficient markets exist when the prices that we see posted for a company reflect the true and fair value of the company, and that through trading activity we have price discovery. Essentially, price discovery is the way that supply and demand for a stock work together to illustrate, to highlight what that price should be. And that price discovery is provided through trading activity, and it doesn't specifically reflect the value or the intrinsic value of the firm. It reflects the nature of the buyers in the market, the nature of sellers. Also people's belief about the future or their sentiment with respect to what future growth looks like, what future cash flows for the firm will look like. It also is going to be affected by things like volume, higher volume, more efficient price discovery, availability of funding to invest in the market. If there's a lot of cash coming into the market, that can affect the price. Regulations, exchange rules, anything that makes markets sticky and makes it difficult for supply and demand to work together. There may also be transaction costs, execution costs, taxation, and information. Transparency of information will be an important part of this as well. Today, we're going to take a look at execution of those portfolio decisions and essentially compare and contrast things like market and limit orders, something you've already had a chance to experiment with. We'll also take a look at how the effective spread works in a market order and contrast it to the quoted bid and ask spread that are used to measure the true costs of trading. We'll compare, contrast, and state examples of different types of market structures, including things like a quote-driven dealer market, an order-driven market, including things like electronic crossing networks, batch auctions, and automated auctions. We'll look at brokered and hybrid markets as well. Some of the execution issues that we'll look at in this session include things like market microstructure. Essentially, that's the context in which trade happens. The things that will make trading less than perfectly efficient. We'll also look at the way markets work, and in particular, markets, when they do work well, provide things like liquidity, transparency. They ensure that transactions will be completed, and they provide a process for settlement, for the actual payment and transfer of documents or transfer of title of the stock. The different types of execution include things like quote-driven trade, which is essentially trading not with the counterparty, not with the actual holder of the stock, but with the dealers who represent them. And that will compare with the order-driven market in which principals can actually trade directly. You can actually buy the stock from the person who holds it. And most stock markets are essentially either brokered or hybrids, and so we'll look at how those work. We have already seen the two standard types of orders, the market and the limit orders. And essentially market orders are distinguished from limit orders because they're executed promptly at the best available price. If we're trading more short shares than are available, or that the other party can provide, the remainder of the order is filled at the second best available price. So in other words, we have an order book. At the top of the order book, there'll be the current low price offer. When we buy all of the stocks that are for sale at the lowest price, then we'll buy the second best set of offers, second best stock offered. This approach is all about immediacy. It's all about completing the transaction as quickly as possible before new information changes the price, either up or down. Now, limit orders, as we have seen, are instructions to accept only prices that are above or below a certain specified number. Below in terms of selling, in terms of buying, above in terms of buying. Typically, they have an expiration time, either good until the end of the day or good until the end of the week or until a certain date. And this emphasizes a set price rather than immediacy. So it's good for getting the price that you wanted, but it might take a while to fill at that particular price. And of course, we do have an impression of how trading works from movies where we've seen people doing essentially pit trading, working in a forum where people communicate directly with representatives of the other dealers using hand signals to buy and sell. And of course, on the edge of the pit, we have got the brokers who are getting information either from clients or from other parts of the distribution network, who communicate with the people by telephone, who communicate with the people on the floor who actually do the trading. Now, this particular approach was very effective because not only did we have the information about the company, but we got a lot of information about market sentiment by reading the behavior from the pit. So if everybody's buying, then clearly there's a strong market sentiment, and that would also affect the price. Sadly, most pit trading has disappeared except in certain types of commodities. In a quote-driven or dealer network, we rely on dealers to establish firm prices. And we also refer to these dealers as the market makers because they're going to be the specialists, also they're called specialists, who will follow certain stocks, make sure that they have all of the accurate information about those stocks, and use that in order to increase or decrease the size of their inventory. So essentially they buy and sell stocks, bonds, whatever it is we're trading, from inventory. Dealers and market makers are also good because they provide liquidity. In other words, if I want to buy a small number of stocks right now, then I can buy them directly from the dealer. I don't have to go to somebody who actually holds onto the stock. The reason why they will hold this inventory is because of the spread between the bid and the ask price. The ask price is the price at which the dealer will sell. The bid price is the price at which they will buy. So the spread will be a positive number that's in between those, and essentially that's the amount, that's the proportion that the dealer can keep. The bid and ask orders may also be limited or subject to a limited number of shares that will be in the order. In effect, they are a limit order that are placed by the dealer. There's also a term that we may hear, the inside quote. The inside quote is generally a non-quoted piece of information that's only available to the dealers. They'll see what the absolute low price is or the absolute high price for a purchase. And we can't see that, but it is actually visible if we're trading outside of these brokered markets in some of the electronic communication networks we'll see later. For example, using our stock track quotations, we can see for Apple this morning when I checked their price, the latest quoted price for the latest transaction was $122.56. But down below that, you can see the bid and the ask price. The bid price was $122.56. That's the price at which you can sell your shares, or that the dealer would buy your shares. And $122.57 is the price at which they will sell. Now, Apple is a very actively traded stock, and as a result, the spread on this is very small. There's only a penny in the middle, and that's going to be available as essentially the broker's fee. Compare that to, for example, a company that a lot of you have looked at recently, GameStop. Here you can see the last transaction price was $219. The bid price, the price at which the broker or the dealer is willing to buy, is $218.77. The price at which they're willing to sell is $219. This is a much more substantial spread of 23 cents. And that's partly because there is a high cost for holding on to an inventory. And this is a very perishable stock. It can lose a lot of value very quickly. And so for that reason, the market maker who's there facilitating the trades is charging you a lot of money in order to do that. And that's one of the sources of funding for some of those trading platforms we've heard about recently, like Robinhood. They don't charge a commission, but they will direct their orders to certain of the market makers in exchange for a payment from the market maker. Different kinds of markets. We have order-driven markets, and those are ones in which the transaction prices are established by public limit orders without having designated dealers. So rather than have the quote-driven market, in the order-driven market, we are essentially putting our orders into a book, and the cheapest orders will be the first one in the book, the second cheapest, the third cheapest. And so without the dealer, we're actually buying directly from the other counterparty. This will, of course, make the market more efficient, but only provided we have no demand for instantaneous transactions. We don't have a dealer who's holding inventory. So this may increase competition for orders or reduce it if there are a few counterparties who are willing to trade. In other words, an order can go unfilled for a long period of time. Current trends in markets favor order-driven markets, including certain specialized versions of these. And these include things like ECNs, or electronic crossing networks, that will put batches of orders together and provide anonymity for the vendors. And so this does not provide immediate price discovery, only periodically. There are also auction markets in which orders compete for execution and price discovery results, either through batches or a continuous process. And you can think of this like a kind of a Dutch auction, the one that I described at the beginning. And then we have automated auctions that are operating continuously and based on a set of rules that will create an order for the execution. Brokers' markets are a variation, really, of the quote-driven market. The broker is an agent for a buy-side trader who collects a commission for skillful trade execution. And that can help to locate some of the natural counterparties. For example, certain buyers will be continuously looking for certain types of stocks, usually institutional investors. And so by buying and selling large blocks of stock through a broker, we're lowering the overall transaction cost. This is especially going to be important if we're talking about securities that don't trade regularly. For example, things like preference shares, which might not trade in a regular over-the-counter fashion. The broker themselves might take the other side of the transaction rather than looking for a client and trade on their own behalf. And they may also provide a reputational screen. In other words, we're not trading with a sovereign fund of a country that we might not like, we're trading with a broker like Deutsche Bank or Bank of America. Hybrid markets are the most common type of market. They're essentially combinations of an order-driven and a quote-driven market, or an order-driven and a brokered market. The New York Stock Exchange and NASDAQs are both versions of hybrid markets. They're essentially a batch auction process for the price at the opening of the market and the close of the market orders, continuous auction during the day, and can also provide a quote-driven process delivered by those market makers, or they're called specialists in the case of the New York Stock Exchange. There are a variety of alternative trading systems. We describe those as ATS, or alternative trading systems. Essentially, this is a way of trading without using an exchange. Electronic trading, or trading through a specialized broker network. Essentially, this anonymously matches buy and sell orders from a pool of participants, mostly institutional investors and broker-dealers, qualified counterparties, so that there's going to be no uncertainty or limited uncertainty about transaction failures, which can completely destroy the system. There are examples of this: LiquidNet, Posit, Pipeline, who provide this kind of after-hours or constant hours trading. Low transaction cost, anonymity are the advantages. Disadvantages: we don't have the ability to immediately execute trades. A variation of this, electronic communication networks. Essentially, this is a type of an ATS. It's fully electronic, provides an electronic order book, is an order-driven system. Good examples of this include Instanet and Arca, which is run by the New York Stock Exchange. And in Europe, they have SWX, which operates the same way. Now, one of the great terms that we hear that affects trading are things like dark pools and sunshine trades. Well, dark pools, essentially, these are private trading forums for large institutional investors. They work just like ECNs, but they're large and very limited entry. It's a good way of trading large blocks of stock without actually showing your hand. If, for example, a company like Apple wants to buy back a lot of its own shares, it may choose to do at least part of the transaction in dark pools so that we can't see how much of the shares they're buying back on that particular day. They may perhaps post part of that trade through a regular trading system as a kind of a sunshine trade to show the effect on price, but by doing the transaction away from public visibility, they're not actually telling people that, oh look, the price must go up because we've reduced the volume of the shares that are publicly traded or part of the public float. Dark pools tend to be either run independently or managed by brokers. The independents include organizations I've already mentioned, like Instanet, LiquidNet. I also run through some of the investment banks, including JP Morgan, Barclays, BNP Paribas, and so on. They can also be run through Euronext and New York Stock Exchange, including the Arca net. And as I mentioned before, there may be a large dark pool trade that's connected to a sunshine trade. In this case, we call them iceberg orders. Brokers and dealers are an important part of this entire system. The broker works for the investor, represents the order, finds the counterparty or the opposite side for the trade, supplies market information. They're typically very discreet, provide other supporting services, including things like record keeping and registry services, and also may provide or broker margin services. They essentially are an important part of the overall market. The dealer essentially is the investor's adversary. They benefit from higher bid-ask spreads, so the less transparency, the greater their fee, the better off they're going to be. And they don't want to trade, particularly with informed investors. They are much more concerned about maintaining low inventory risks. The next part of our session, we're going to take a look at when markets are efficient. What is market quality like? A good market is one that will provide liquidity. You can get what you want when you need it. Typical indicators of a highly liquid and highly effective market are ones with very low bid-ask spreads. And we also want a market in which we can do a medium to large size trade without moving the market. So we'd say that market has depth. And resilient, one that can adjust to discrepancies between the market price and the price that's revealed through trading. Transparent. Transparency is another important part. Quick, easy, inexpensive access to quotes and trades, and rapid public dissemination of trade details. Markets that are not transparent generally require a very large premium for us to invest in those stocks. A great example came from Japan in the 1980s and even into the 1990s, when information was only made available to Japanese investors, and that was because all of the new information about major company events was posted inside the Japan National Press Club. After 30 minutes, that information would be posted on a bulletin board outside the press club, where foreign news sources could then get that information. That meant that foreign investors were always 30 minutes out of the loop. And that meant that there was a much smaller pool of international investment flowing into Japan. And eventually, of course, that had to be resolved. We also want to make sure that deals complete, that both parties, the seller and the purchaser, will uphold their obligations. Here we have an example of how important turnover is to markets. On the left-hand side, we see markets like China, Turkey, Italy, Japan, with total turnover as essentially the total sales of securities as a percentage of the actual floated stock being as high as 180%. That means that stock is turning over twice a year. U.S. markets are in the middle with about 100% turnover. And over on the right-hand side, you can see countries like Colombia and Peru, where perhaps only 5 or 10% of the stocks that are traded on that market actually turning over during a year. So the more turnover, the better the price discovery. We're also concerned about concentration. Is a national market made up of 10 or 15 or 20 major stocks that trade all the time, and maybe 20 or 30 small stocks that hardly trade at all? So the more concentration, the less valuable the market is. There has to be an alternative. When you sell your shares in one stock, there has to be something else to buy. So a market dominated by a few firms provides fewer opportunities for diversification and active portfolio strategies. For markets like the New York Stock Exchange or the Tokyo Stock Exchange, the top 10 firms represent less than 20% of the total market capitalization. Compare that to Switzerland with huge players like Nestle. The top 10 firms account for a total of about 70% market capitalization. You can see here, Switzerland is definitely the greatest, followed by countries like Italy and Hong Kong. Other countries like the UK in at about 40%, Germany about 45 or 50%, Spain and so on are in the middle. The lowest concentration, markets like New York Stock Exchange, the Tokyo Stock Exchange, with less than 20%. In the next section, we're going to take a look at execution costs. Obviously, if you're part of an active trading strategy, high execution costs means that the transaction cost deadweight loss for every transaction will be great. These include things like the explicit costs of direct trading, commissions, taxes, duties, exchange fees, but also, and sometimes more importantly, some of the implicit costs, the bid-ask spread, the market impact of trade, the opportunity cost of a trade that's initiated but not completed, and delay costs. We'll look at each of these in turn. One of the reasons why we're concerned about some of these indirect costs is the implementation shortfall. Essentially, that's the difference between the money rate of return in a theoretical portfolio and the actual return that we get from our real portfolio. And this implementation shortfall is caused by some of those explicit costs, but probably more importantly, things like the realized profit loss based on price movements before we actually own the stock. Delay costs, the difference between the closing price and the execution price for the orders that are not filled in the day that we tried to do the first trade. Opportunity cost for orders that don't get filled at all, unrealized profit and loss. And we can compare the shortfall, the implementation shortfall, by removing the effects of market return. From the McGinn textbook, we can see that the total transaction costs are presented like an iceberg. In this case, the explicit costs are things like commissions. In 2005, commissions were about 9 basis points, a very small part or small cost in total. Market impact was greater at 12 basis points, but the delay costs themselves were as great as all of the explicit costs. And they're under the water. They're part of the hidden part of the iceberg at 21 basis points. And then missed trade and opportunity cost, those costs were about 9 basis points. So hidden costs, implicit costs were about 30 basis points compared to about 21 basis points for the explicit costs. Implementation shortfall as a measure of transaction costs is something that's useful to us because, well, it links trading to portfolio manager activity, linking the cost to the value of a particular strategy. It recognizes the trade-off between an immediate transaction and its price, allows attribution of the transaction costs, and can be built into programs, and we'll talk about those in a minute, that will provide us with the optimum level of turnover in our portfolio. Some of the disadvantages of implementation shortfall, well, it requires collection and interpretation of data, and it might be unfamiliar as a framework for traders. You can see the average total execution costs in basis points from an old survey that was done by Barclays. And some of the highest cost markets, and again this goes back to 2002, we can see that in India, market impact was the largest part of our transaction costs or execution costs, followed by commissions. Other markets, including for example South Africa, had high costs, but not so much because of market impact, more because of commissions and also because of taxes, in particular taxes on purchases. In the UK, there was a very large transaction tax that was called a stamp duty, which was essentially a very large incentive to not trade because the stamp duty was a deadweight loss. It essentially said once you bought into that stock, you better stick with it. Now, of course, this information is out of date. We don't have more up-to-date information, at least not presented in that format. Well, one of the ways that we measure the overall performance of our transactions, and we can use this to evaluate our broker, is something called the volume weighted average price, VWAP. That's the average price at which a security trades during the day, weighted by the volume traded at each particular price number. It allows us to estimate the implicit trade costs by comparing the cost at which we filled our order to the volume weighted average price. It provides less information if our trades were a large portion of the daily volume. So if we move the market ourselves, we would tend back towards an average number. And you can also try to game the volume weighted average price by estimating the total volume weighted average price to trades up to a particular time. So depending on the sample time, the sample bucket that you use to measure it, you'll get a different volume weighted average price. You can see how this works in an example. This is a quote that's provided by NASDAQ for Ballard Power Systems. Located in North Vancouver, they produce hydrogen fuel cells that are used in buses. And from time to time, their stock price has been quite volatile. They're a great stock to watch, or they have been in the past. On this particular day, when I downloaded this information, they closed for the day at $5.99. Now, if you put in an order during the day, you could have had your order filled at many different prices. You can see from the quotation that the stock opened at $4.68. It reached a high of $6 during the day and a low of $4.57. So ideally, if you were talking to your broker, and you said, "How did I do today?" He said, "Well, we did okay. We filled your order at $5.98. You say, "Well, that's terrible. The stock price was as low as $4.57. Why didn't you buy it then?" Well, great question. One part of the answer would be that looking at the average trade price during the day, the volume weighted average price, the one that's provided in the bottom right hand quarter, is $5.13.59. That means if you had bought during the day at an average price, that's the price that you should have filled at. Now, if it's higher than that, your broker didn't do a good job. And if it's lower than that, your broker did a very good job. So we can't actually say to the broker, "Well, you should have bought when it was lowest." Nobody knows when the price will be lowest. But if they bought at $5.98, they obviously missed the opportunity in that particular trading day. It's a measure of the explicit transaction costs. It's easy to compute, easy to understand, easy to communicate with our clients. Can be computed quickly to assist traders during the execution. Works best when we're comparing small trades in markets that haven't got a clear direction, either up or down. They're not trending. Disadvantage, it doesn't account for the costs related to delays, trade cancellation, some of those implicit costs. It's misleading if your trade represents a substantial portion of the volume. It's not sensitive to trade size or market conditions. And as mentioned earlier, it can be gamed by delaying trades to a different trading period. We also use econometric models to estimate trading costs. And of course, we know how econometrics work. There's a complexity involved with this, but we have to identify certain factors that are going to determine overall trading costs. Things like liquidity characteristics, risk, trade size relative to the total size of the float or the liquid market, momentum, and trading style. And from this, we can provide a non-parametric or a non-linear regression of those relationships and use that to compare the theoretical price to the actual price that's paid. In our next section, we're going to take a look at different types of traders and trading strategies. Of course, we all aspire to be the trader in this picture, sitting at our desk we've got about 10 screens in front of you with all kinds of important information, looking for key bits of data or information that will indicate value. Perhaps one trade is telling us about the movements in interest rates, another screen is giving us the political information, and so on. And can we incorporate that into an actual trade? Now, that kind of trader trades on information. You can compare that to a value investor, for example, like Warren Buffett, well known for looking for underpriced assets, buying and holding onto those. So the value investor is not looking for the most current information, not buying in the morning and selling in the afternoon. They're there to buy and to hold. Of course, there are a lot of different types of investors. These are two of perhaps 4 different variations. Information-motivated traders trade on information that becomes valueless if we wait. So we have to have fast execution, instantaneous execution. In some cases, day traders will locate on a high-speed internet trunk line so that their transactions can be processed faster than someone else's. Liquidity, speed of execution are going to be the most important parts of their trading activity. They're most likely to use market orders and to rely on market makers who provide that liquidity for a price. They trade large blocks to maximize the value of the information. And successful information traders will require anonymity because nobody wants to trade against those famous, well-known, and successful traders. The other end of a spectrum, we have the value-motivated traders. They act on judgment based on careful, painstaking, and long-term research. They trade only when the price moves within their particular value range. They have an idea of intrinsic value, and they'll only purchase when the selling price of the stock is below their target intrinsic value. They trade infrequently. They're mostly motivated by price and their perception of value. They accumulate and hold large positions. Do this quietly, and they do it over a long period of time, and they're patient, waiting for the best price. Now, we also have a couple of other variations. We have liquidity-motivated traders, and for them, their transactions are more of a means to the end. They need the cash in order to meet some obligations. Asset liability management, in order to make payments perhaps to pensioners or to an insurance claimant. The trades are not sensitive to new information. They tend to be the natural counterparties to other traders and provide a certain amount of value through the provision of liquidity. Passive traders are traders who are working for index managers who are operating essentially on the behalf of savers. They're looking for liquidity to continually rebalance an index portfolio. They are sensitive to costs of trading because that creates the tracking error that we talked about earlier. They use time-insensitive techniques to exchange lack of urgency for lower cost execution. And they tend to look a lot like dealers in their day-to-day activities. Some of the trading tactics, and we do have a list of, I think, of about 6 of these. We saw first that liquidity traders are interested in liquidity at any cost. They need immediate execution for large blocks at high cost and are willing to put up with high market impact, driving down the price of driving up the price of the stock that they later on hope to buy. A second trading tactic needs trustworthy agent, large-scale trades without advertising that there is an important buyer in the market. Willing to pay a higher commission for this. They're hoping to get a fast execution, but they lose direct control of the trade. Then there's the cost not important. Certain execution by paying the spread to obtain a competitive price in a quote-driven market for at the loss of a potential better price and direct control of the trade. Then we have the advertise to draw liquidity, essentially the sunshine trades that we talked about earlier, and they're used alongside of large trades with low information advantage to find the market price. Essentially, this becomes the sunshine part of a dark pool trade. And then there's the low cost, whatever the liquidity, minimizing commission and transaction cost at the expense of certainty of execution. Now, these are some of those trading tactics. Now, we have a couple of other variations that are very common in large trading systems, including variations of algorithmic trading or machine trading. And essentially here we're allowing a computer to make our trading decisions. Electronic trading that's going to be subject to quantitative rules and benchmarks and constraints that are supplied by the program manager. They're looking for market patterns of trading in order to find bargains. And they can find a very small amount of market advantage and leverage it by doing very large trades. Also, these can be described as logical participation strategies or implementation shortfall strategies. Logical participation strategies, those are the ones that are used to participate in overall market volumes without high visibility. Volume-weighted average price strategy breaks orders up according to a particular volume profile in order to improve or to gain the day's volume-weighted average price. And a trade-weighted volume-weighted average price strategy assumes that there's a flat profile and makes trades in proportion to time. Something that is possible to do only really with thinly traded securities. And then there are percentage of volume strategy trades that trade in proportion to overall market volume until the total purchase has been completed. Then we have implementation shortfall algorithmic trading strategies that we mentioned earlier. This provides an optimization for the lowest possible trading costs measured by implementation shortfall. Now, typically done early in the day to exploit the out-of-hours liquidity trading and useful for portfolio trades and for managing transitions between different fund managers. Last couple topics. What is best execution? Essentially, there is an obligation for dealers to provide best execution for the client, not for themselves. Essentially, it's a trading process that seeks to maximize the value of our client's portfolio within the client's stated investment objectives and constraints. So it means that it's going to be well connected to our investment decision or hypothesis. We can't know with certainty beforehand what the best execution is going to be, but it can be measured afterwards or ex post. And it's going to be, can only be understood within the overall pattern of trading of our fund manager. Some of the guidelines, well, our process should be built around maximizing the asset value of our client's portfolio. And we have to make disclosures with respect to trading techniques, venues, and agents, and the actual or potential conflicts of interest that are a result of our trading activities, and that our record keeping needs to document that we comply with these policies and procedures, and that we provide full and timely disclosure to our clients. Now, of course, one of those last topics, ethics in trading. We always leave this one to the end. Essentially, for a trading system to work, we have to be able to count on the good faith of our trading partners. There are some remarkable examples of traders who recognized that the counterparty was making a stupid mistake, and they got on the phone, and even though it delayed the trade, said, "Are you really sure you want to do this?" And that's the kind of thing that creates a legacy of honor within the business that is often thought of as being very dishonorable. Verbal agreements must be honored in trading, or there won't be anybody who's willing to trade with you or trade with anyone. Trading can be viewed as a zero-sum game, and as we see that markets are going to be more focused on spreads and less on commission, relationships are likely to become more adversarial. And whenever we're talking about our loyalties must be to the client, and not to other investment managers, and not to people within our trading network. A very complicated and important topic. I hope you've enjoyed it. I look forward to talking to you more about this in our next session. Thank you.